Welcome. So today, we're going to tackle a question that pops up for pretty much any investor at some point, a stock rights offering. You know, when a company you own decides to issue new shares at a discount, but only to people who already own the stock. So let's dive in and figure out what one of these rights is actually worth.
Right, so imagine you get an email about this. On the surface, it sounds like a fantastic deal, right? But it's not exactly free money. There's a real specific value to these rights, and you need to know what it is to figure out the smartest move for your portfolio.
Okay, so to figure this out, we have to put on our detective hats and look at the details. Every single one of these offers is a little different, so let's break down the exact terms of this specific deal.
The first piece of the puzzle, and really the foundation of the whole thing, is the ratio. In this case, the company says for every 5 shares you're holding right now,
you get one single right. Now, this right isn't a share itself. Think of it more like a coupon. It gives you the option, the opportunity to buy one new share. So the magic ratio here is 5-to-1. Simple enough. Now, before any of this kicks off, the stock is just trading along on the market for 11 shekels a share. This is our starting line. It's the baseline we're going to use for all our math. And here's the juicy part, right? This is the incentive. The company isn't saying, hey, buy more shares at the full price. No, they're offering you a pretty sweet 25% discount. That's the hook to get you, the existing shareholder, to participate.
All right, we have all our clues. Now we can actually start putting this puzzle together. But here's the thing, and it might seem a little backward. Before we can find the value of the right, we first have to figure out what the share price is going to look like after the deal is done.
we're going to do this in 3 really logical steps. First, we'll figure out what that new discounted share actually costs. Then, we'll bundle everything together, our 5 old shares plus our 1 new one, to get a total portfolio value. And finally, we just average that total value across all 6 shares to find the new theoretical price.
Now, this is absolutely the most important idea to wrap your head around. The company's total value doesn't just magically go up because they printed more shares. Nope. This same value is now just spread out over more shares. It's called dilution, and it's the entire reason the stock price has to adjust downward. This is the key.
So let's just walk through the numbers on the screen. See, your 5 old shares, they're worth 55 shekels. Easy. Now, that 1 new share you're buying only costs you 8.25, thanks to that 25% discount. Add it all up, and you've got 6 shares with a total value of 63.25. Now, just divide that total value by your 6 shares, and we get our new price. And there you have it, 10.54 shekels. This is the new theoretical price of 1 share once it starts trading X rights. And that term just means without the rights. So the price had to drop from 11 shekels because of that dilution we were just talking about. Makes sense, right?
We are in the home stretch now. Believe it or not, after all that work to find the adjusted share price, calculating the value of the right itself, well, it's actually the easy part.
The formula couldn't be simpler. The value of that right is just the difference between what the share is going to be worth on the market, that 10.54 we just found, and the special discounted price that you get to pay for it.
And boom, there's our answer. You take the new market price of 10.54, subtract the special price of 8.25, and you're left with 2.29 shekels. That is the theoretical on-paper value of 1 single stock right. That's what you're getting. Okay, so we've got the number 2.29. Great, but what does that actually mean for you? You know, as an investor holding these things, what are you supposed to do with this information? Okay, listen up, because this is the most important part. That right you're holding is a real asset. It has value. But that 2.29 didn't come from thin air. It's the value that was shifted out of your original shares because of the dilution. So your total wealth is the same. It's just been, well, repackaged. Now you have 3 choices. 1, you can exercise the right and buy that cheap share. 2, you can sell the right on the stock market to someone else for around 2.29. Or 3, you can do nothing and let it expire, which is basically like taking that 2.29 and setting it on fire. So we've perfectly calculated the theoretical value in a nice, clean spreadsheet world. But that brings us to the final, big question. The real world is messy, right? How might good news, bad news, or just general market panic or greed affect the actual trading price of that right? How much could it swing above or below that 2.29 we calculated? That, my friends, is where the art of investing meets the science.